Today, we're looking at TFSAs, RRSPs, and Canada's new tax-free first home savings account. We're going to look at which one is best for you and how you can get started right away. For those of you just joining, my name is Brandon. Welcome to the channel. This is where we talk about finances, investing, your career, and all the other pieces that fit in there. If you enjoy this kind of stuff just as much as me, hit the like button below. And if you'd like to see more content just like this, subscribe. Let's dive in. The TFSA, RRSP, FHSA, they're all very similar in nature. Government programs, vehicles to help you save and invest your money for the future. You report your contributions, your withdrawals to the government, but in doing so, you can save some taxes that would otherwise be incurred in a non-registered brokerage account. Number one here, guys, the TFSA. The concept of this is very simple. You contribute after-tax dollars. This is money deposited in your bank account, and any investment earnings, growth, and then your future withdrawals can be taken back tax-free. I'll say that again. You contribute after-tax dollars. However, any future investment income, any withdrawals can be taken back tax-free. Each year, Canadians are allotted the same amount of contribution room. This past year, that was $6,000. So if you turned 18 this year, you can contribute up to $6,000. However, if you turned 18 in the year 1991 or earlier, that was when the program was started, you get the maximum amount of contribution room. Can't stock away $6,000 this year? Don't worry about it. Your contribution room accumulates year over year. So let's take a look at myself, for example. Assuming I don't hold a TFSA, I could go to my brokerage, plop in that $40,000, put it all in crypto, grows to $1 million over the next 10 years, pull it out completely tax-free. That is the benefit of a TFSA, the tax-free growth. Number two, the RRSP. The RRSP is a bit more technical, but there's really only a couple things you need to know. You're going to contribute pre-tax dollars. This money is going to grow tax-free. However, any drawings in the future are going to be taxable in the year of withdrawal. So I'll say that one more time. You're going to contribute pre-tax dollars, therefore you'll get a deduction on your tax return. However, that money's going to grow tax-free, and then in the year of withdrawal, when you're in your retirement years, it'll be taxable. RRSP contribution room is not fixed for every Canadian. In fact, it's based on a percentage of income, 18%. The only difference here is that you can begin developing this contribution room before you turn 18, and that's where it differs from a TFSA. There are some limits on RRSP contribution room. Once you start making over $150,000, there's a cap. But let's say for simplicity's sake, you made $100,000 in 2022. That means your 2023 contribution room is $18,000. Let's say you plop this $18,000 into your brokerage account, you put it into Dogecoin, grows to $1 million over the next 10, 20, 30 years, and then you pull it out in retirement. It'll get taxed at your marginal tax rate. For simplicity, let's say you're left with $600,000 after-tax dollars. Basically, pre-tax contribution, post-tax withdrawal. Now, the FHSA. The FHSA tries to take the best of both worlds from your TFSA and your RRSP. So you contribute pre-tax dollars, that money grows tax-free, and then in the year of withdrawal, it's also not taxed. So basically it takes the pre-tax contribution of the RRSP and then the free tax withdrawal from the TFSA. Win-win. Now, the FHSA was just introduced by the government, and this is going to take effect in 2023. Similar to the TFSA, every Canadian is going to get a fixed amount of $8,000 per year, up to a maximum of $40,000 over the lifetime. The caveat to this one is that you must be a first-time home buyer. Now, CRA defines this as not owning a home in the year the account is created or in any of the preceding 4 years. Taking this one step further, when the funds are withdrawn, they must be put towards a qualifying home purchase. Any funds that aren't used as that down payment can be transferred tax-free into an RRSP. So these accounts will be available with banks and brokerages starting in 2023. Let's say you can contribute your $8,000 in 2022, 2023, all the way through to 2027. By the end of it, let's say the money grows to $60,000. There, you can take that money, withdraw it, put 20% down on a $300,000 home. Now let's say you got a spouse, significant other that was doing the same thing. There, by the end of it, you have $120,000, which is the equivalent of 20% down on a $600,000 home. There is some scrutiny on the FHSA because it's very similar to the home buyer's plan that's currently offered by the RRSP. Totally fair. It makes things more complicated for everyday Canadians. It gives reason for accountants to charge more on your tax return. However, at the end of the day, I look at the home buyer's plan as a withdrawal from your future, taking a loan from yourself, from your retirement income, whereas the FHSA gives you an opportunity to save for the first down payment on a home on a tax-free basis. So I think it's pretty good. So which of these plans is best? Well, none of them. To be honest, it all depends on your position in life and what you're saving for. In my opinion, the TFSA and the RRSP have a long-term retirement focus, while the FHSA offers a short-term option to get your first down payment on your home. These three accounts are the first step to begin developing wealth, and therefore I think everyone should be maximizing their contributions in these before they begin looking at other retirement options such as registered accounts, cryptocurrency, real estate investing, Cousin Jerry's private business. You get the point. When invested properly, these vehicles can require the smallest amount of time and offer some of the greatest returns over the course of your life. Maxed out on all these registered retirement options, TFSA, RRSP, FHSA, don't worry, we're going to have another video coming out that's going to show you the next steps to building wealth. So which plan is right for you? Well, this answer is going to vary person to person, depending on where you're at in life and investing. If you and your family are eager to get into a home, then I do recommend the FHSA. Contribute your $8,000 per year starting next year, and then move into that TFSA and RRSP option. If you find that at your current income level, you can only max out the FHSA, or you can't even max that out, don't try to balance out your FHSA, TFSA, RRSP. Just focus on that down payment for the next 2 to 3 years. Try to get that to as high as you can. Don't try to mix and mingle between the three because you're just going to draw on your future and then you're not going to get the down payment as fast. Just focus on one thing at a time, and that's how you're going to get there. So how should you invest your FHSA? Go to your bank or brokerage, set up an account with them in 2023. And what you're going to want to do, guys, is you're going to want to put this in a high yield savings account or a 1-year GIC. I just saw the other day you can get up to 4.5% in a GIC. And what this is going to do is going to lock in some return for you. It'll try to keep up with inflation, but you won't be putting your money in the stock market and risking a loss over the next 2, 3, 4 years. This is very short-term money, and you don't have a long-term investing horizon. Therefore, I wouldn't recommend getting too risky on this account. Yeah, the stock market does average 10% over the long term, but not over 3 to 5 years, which is when you're going to be using this investment. Honestly, guys, even if you don't think you're ever going to move into a home or make that purchase, maybe you're not set on what city you're living in and don't want to take advantage of the FHSA, I encourage you to do so. It gets the advantage of both the TFSA and the RRSP. And at the end of the day, which I think is 15 years, you can transfer that money into your RRSP tax-free, not affecting that contribution room. Therefore, it's a great alternative whether or not you think you're going to move into a home. So then the next real question here is TFSA or RRSP? This one can get a bit technical from a tax perspective, and to be honest with you, if you're investing in either of these, give yourself a pat on the back right now because you're already doing better than 30% of the population. But if you're a tax geek like me and you want to figure out which one you should be contributing to, assuming you can't maximize both contributions, check out the link below where we calculate which one offers the best after-tax return. And as a general rule of thumb, if your income is higher now than it will be in retirement, this is when you want to maximize your RRSP contributions and take advantage of the deduction. Contrary, if your income is lower now, maybe you're just getting started out making $40,000, $50,000 a year, and you expect that your retirement income is going to be higher than where your current income is, then you're going to want to maximize those TFSA contributions and then utilize your RRSP contribution in the future as it carries forward. Lastly, where should you invest your TFSA or RRSP? I personally use Quest Wealth to manage all my investments. I dropped a link down below. I don't get any affiliate marketing from them. I honestly believe they're a stress-free, simple, low-cost alternative to investing. You can check it out today. Set up your account, your investment horizon, your risk profile, and then automate those contributions. Over time, you're going to sit back, you're going to watch your money grow. That's all for today. Thanks for listening. Drop a like below, subscribe. Whatever you do, pay yourself first.